Hey, Dan Passarelli here. Happy almost Turkey Day Eve. It is the Wednesday before Thanksgiving here in the United States. And so the market is closed tomorrow, which is why we saw some pretty light trading today and some lower volatility this week, both in terms of actual stock volatility and implied. But we have another half a day this week. Friday, the market's going to close early. So the market pulled back just a smidge today, about 0.3%. And a lot of the reason for that is, they say no news is good news, but I don't know, the same old news is kind of apparently bad news. Because we had initial jobless claims come out today at 213,000 versus 215,000 estimate. So, basically no change. The core PCE prices, which is the Fed's favorite inflation gauge, was actually down 0.1%. It was 2.1% versus 2.2% expected. So a smidge. But then the core PCE was 2.2 versus 2.2 expected. And then GDP was pretty much right in line as well. And so, it was basically just what people expected. And we got a little bit of a natural pullback. And we see that sometimes, profit-taking Fridays after a bullish week. You don't see it all the time, of course, but you do sometimes. And I think that's part of what we're seeing happen. Now, on Friday, there's not really a lot of activity either. The only thing that's coming out on Friday is the Fed's balance sheet numbers, which, is somewhat important. But next week we have JOLTS. We have, what else? The Fed's Beige Book, which people pay attention to. And let's see, Challenger job cuts. Next week is the first Friday of the month, which means we get non-farm payrolls. So we do have some stuff coming up next month. Apparently, by the looks of it, if it's not good numbers, it could be bad news. Now, there's one other thing that caught my eye here, and that is this very, very slight divergence that we see between SPY and RSI. Now, RSI is something that I talk about time to time because it is one of those things that I use, and there's a number of different ways to use it. But there's two ways that I use it that are a little bit more towards the advanced side of using it. Nothing super fancy, but not quite the simple way that a lot of people use it. And one of those ways is to look for divergences. And divergence, that word means, doing something different, right? So we had back on the 11th of November, we had a new high at that point, and we had a new high in RSI. And then we kind of pulled back a little bit, and we had a new high yesterday that was actually a new all-time high, so a higher high, slightly higher high. But we had a lower low in RSI, so that's called a divergence, where the indicator is doing something different, divergent from what the market is doing. So what we do with most divergences on most indicators is we fade the actual market and we trade the actual indicator, because that's the whole point of indicators, isn't it? That they manipulate the data so that you see a more clear picture. So this would be a somewhat bearish picture here. Now, if this was a even higher high, I would be a little bit more pessimistic to the downside, for the downside. But, it's really just like barely kissed brand new highs. But hey, if anything, from a technical standpoint, this does lend itself to a little bit of maybe an increased chance for a pullback. But that being said, it's been a good year for the stock market. We have a lot to be thankful for. And that's what this time of year is for, to think about the good parts of our life and to be thankful for them and share that time with family and other people who are important to us. That being said, I'll see you on Friday. Have a great day off.